This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and you're watching Talk Your Book, and today we're very fortunate to welcome back our repeat guest, Jun Bei Liu from Tribeca Investment Partners. Jun Bei, thanks very much for coming back on the show.
Well, Chris, thank you so much for having me.
Now, what stock did you want to talk about today?
Look, today I want to talk about A2 Milk, a name what probably most of people have heard of. To us, at this point, the company represents significant amount of return opportunity for investors.
Yeah, you're right. A lot of consumers will be familiar with the A2 Milk brand, but maybe from the 10,000 foot view, give us an oversight of what different business units A2 Milk have and perhaps which geographies they operate in.
Of course. Look, A2 Milk, it first started a few decades ago, essentially creating sell the milk with the A2 special A2 protein. So that really helps with, the study have found, that help with people who's lactose intolerant. So the A2 milk was first started in New Zealand and then in Australia. It took off in the marketplace because consumer really like that product. So they were initially in the liquid milk space, and then they moved into the infant formula space, and that's which took off very quickly within the Australia and New Zealand market. And then the company have started branching out into the US and as you all know, that the Asian consumer has discovered this infant formula brand as well, and it has since resonated with the consumer in Asia, particularly in China. So for this business, the biggest part of the of the earnings come from Australia, New Zealand, and Australia being the largest market, and China once upon a time has been quite a large market, and I'll come to it. At the moment, it's represent much smaller component of it. And US is mainly the more liquid milk space. And more recently, actually, they have held a temporary license to produce some of the infant formula due to their infant formula disruption because Abbott's had a bit of a recall, and A2 was one of the producers that was selected to produce to meet the short-term demand. Now, coming back to to the growth in the Chinese market. Now, for A2, this business, its infant formula product was discovered by Chinese consumer many years ago, and it was such a hit, and it went through the roof in terms of sales, and the Chinese consumer really want to buy this product, and it was quite difficult to get to. So they managed to, as A2, they built their distribution into China. They created the China label product. They sell through the Daigou channel, which is a lot of traveler from China to Australia and buy some of those infant formula and ship it back to China. So many distribution were built over the last decade, and then we have seen the maturity of those distribution channels, and the company is going from strength to strength in terms of taking the share in the China domestic market. Now, the company's earning did get hurt when the hard lockdown took place in China, and then there was a lot of pull forward in inventory buying, and then consumer was destocking. So there was a lot of disruption to earnings. So the Chinese earnings really have fallen during that period. Plus, there was no visitors coming to Australia, and so the Daigou channel essentially evaporated. So long story short, the company's earnings are now on a very good trajectory to really capture the growth in the reopening in China, with their borders now opening, with the travelers coming through, with the shops open, with the consumer willing to spend. At the same time, there's growth opportunity coming through the US as well as the continued strength in the Australian business.
When you look a few years down the path of sort of broker forecasts for A2M, they've got the Australian, New Zealand business particularly starting to drop off as China scales up. Is that do you see that as market conditions, or is that the deliberate strategy of A2 Milk to really double down on the opportunity over there in China?
Look, they certainly have invested a lot of have a lot of investment into China, but Australia, I think brokers tend to be a little bit more conservative with the mature market. So because they have dominated share within Australia and New Zealand, so there is expectation that they will sort of grow at maturity, which is sort of status quo plus a bit of a pricing environment. And now China is going to be a key growth space for this company. It's I guess one of the key thing is that not many Australian company has done well and consistently done well, in terms of execution into the Chinese market because it's very competitive, it's very expensive market, and many of the competitors have gone and failed. Now, A2 has been different. It certainly seems like they continue to grow share in the in the Chinese market, even during the tough times. Not only they're growing share in the top tier one city, even tier two, tier three, we're seeing good penetration into it. So that simply means the brand is now well known in the Chinese market, and that represents a lot of opportunity. So it's it's absolutely right for the management to be really increasing investment into that space, and then we should see the return from that market.
And it was a few years ago where Treasury Wine ran into challenges with their Chinese exports, and we know that some of the Australian coal producers had some challenges there a couple of years back. Do you think those issues around potential sanctions on Australian products with China, do you think that risk has potentially been reduced? And also, do you think by the nature of what this product is, e.g., particularly infant formula, it's a product that is less likely to run into those sorts of issues?
I do think so. I think if you talk about well, actually, there's a two level to that question. First of all, in terms of trade relationship with between China and Australia, certainly seems like it's thawing, and now we're seeing we China's started allowing a few products already through. There's barley, there's coal. Certainly, there's positive news coming through, and the Australian wine potentially the tariff might be reduced or removed is all very very positive news. So we do think that a bulk of that tension in terms of trade relationship has passed. Now we are going to a more smoother period. Now, put that aside, infant formula is quite different. When China look at imposing the tariff, it's really wanting to do things on a few more signature, product that represent Australia. So, the likes of coal and the likes of wine, because wine has had incredible growth in the last 2-3 decades, really, into the Chinese market. And Penfold, it's almost, it's Penfold or Grange. It almost just represents Australia in China. So that was almost a little bit of picking the most important product or most significant product, really just to demonstrate the conflict, really. So we think the infant formula is a bit different. It's a little bit under the radar. A2 is essentially actually is a New Zealand sort of business, a New Zealand business. Its milk bulk of it come from New Zealand. So whether it's fully Australia, it's a little bit different. Also at the same time, because it's for for babies, and as you know, once the babies start using certain infant formula, mothers don't really like to change them, and particularly the Chinese mothers. So it's something that doesn't really stand out too much in the spotlight as you like.
And in terms of recent acquisition in the space, Kieran's purchase of Blackmores, which was done a really chunky multiple, when you see that sort of a transaction go through, does that give you confidence that a business like A2M could be on the radar of larger acquirers at some stage?
Oh, look, absolutely. Look, I'm surprised that it hasn't happened yet. A2 is represent incredible value at this stage. It's still got close to $900 million sitting on the balance sheet. That is very unusual for a listed company. So if you adjust it for that, you take out the cash valuation, this company is trading on close to less than 20 times earnings on 2024, and it will grow something like 30%, and then in the low 20s, and then in the teens forward profitable going forward. So, this company has such high growth with very, very strong balance sheet. And then, it's sort of experiencing some of the short-term earnings volatility. It just really surprised me the share price is not higher. I think at this point, investors just sort of haven't really stepped back in and pay attention to it. My view is that it's not going to stay here or stay cheap for very long. We've seen the same thing before with the likes of Treasury and the likes of other branded businesses. They just don't stay cheap for very long, particularly balance sheet is so strong.
And you mentioned that balance sheet strength. What sort of capital management initiatives could you see them doing, or could you see them perhaps looking at smaller bolt-on acquisition opportunities?
Yeah, look, I do think it's possible. So, A2 have always talked about, they are a growth company. They're looking to grow. It's if one day they started buying back their shares, the problem means that, growth the opportunity is lacking. They always look to buy, vertically integrate their own businesses. So they've got a stake in Synlait, which is a producer of their product, and to, seem to vertically integrate. And they always look at potential for, bolt-on, maybe potentially even other vertical extensions of that brand. So, it's great to have cash on the balance sheet, particularly in today's world where, capital is expensive to come by. Over the next 12 months, you will see a lot of ASX 200 companies or 300 companies to come out and raise money at a, big discount, whereas this company is already well capitalized and just waiting for the opportunity to present.
And you mentioned Synlait, who are A2M's biggest supplier, I believe. I reckon there's been a bit of confusion in the market around Synlait's forecast for their growth and how that translates into A2M's forecasted growth. How have you sort of measured up some of the confusion between those two different data points in the market?
Sure. So A2, even though A2 is a big customer for Synlait, but there is a lot of other customers as well. So for Synlait, so that's number one. And second, A2 we find because of management quality, they tend to tell us a little bit earlier about what's happening. So we actually heard from A2 in February about the volume is potentially a little bit weaker. It's because the Chinese label is growing really well, but the English label is a little bit slow because of the traveler have yet to return to Australia. So the Daigou channel is a little bit slow. But it really just missed the expectation by a couple of percent. So, and then a few months down the track, we heard it from Synlait. So, my view is that, A2 is a very strong operator, and then they've been very transparent in terms of the performance of the business. Given they are in a much stronger position in terms of compared to their supplier, we do think they have the bulk of the power in terms of demanding better better pricing and the like. So so for me it's not a straight read through. People tend to do that, and that does provide a pretty good buying opportunity.
And you touched on the numbers before, but maybe just to spell it out for us all one more time, if you can just give us the overview, their PE, what sort of their market cap, and what their top line growth numbers you could see them doing in the next year.
Yeah, so let me just get to market. Market cap is just under $4 billion. It's listed on both, Australia and New Zealand Stock Exchange. The P, if you adjust for the cash, which at the moment, net cash just under $900 million. If you adjust that, the company trading on 21 times earnings next year. It's expected to grow 30%. And bulk of it is due to just recovery in the Daigou channel and China reopening. To me, that is incredibly cheap. I just want to also provide some comparison. It is a very defensive, as you know, is sitting in a consumer staple place. These compare with the likes of Woolworth, trading on 26, 27 times earnings next year, and will deliver growth of between 0 and 5%, or compared to the likes of Coles, which is around 22 times and deliver growth, around that sort of 0%, or even compared to the likes of Endeavour, that is still trading at above 20 times with, almost flat sort of growth. So, put that all together in perspective, A2 is, very attractively valued.
It's a compelling story and explained incredibly clearly again. So Jun Bei, thanks very much for coming back on Talk Your Book.
Thank you very much for having me. Go buy A2 today.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Judd Invest.